Hello everyone and welcome back. This is your weekly gold and silver market outlook, where we break down the key factors that could drive prices in the week ahead. The overall outlook remains cautiously bullish, but investors should expect increased volatility as several major economic events approach. The biggest driver will be the Federal Reserve. Markets are closely watching for any clues about future interest rate policy. If the Fed signals that rate cuts are becoming more likely, gold and silver could extend their gains. However, if policymakers maintain a hawkish stance, higher interest rate expectations may pressure both metals. Another critical factor is the US dollar. A weaker dollar generally supports gold and silver because they become more attractive to global investors. On the other hand, a stronger dollar could limit upside potential. US Treasury yields will also play a major role. Falling bond yields usually benefit precious metals by reducing the opportunity cost of holding non-yielding assets like gold. Rising yields, however, could trigger short-term selling pressure. Geopolitical tensions remain another important catalyst. Any increase in global uncertainty could boost safe haven demand for gold, while easing tensions may reduce that support. Central bank gold purchases continue to provide a strong long-term foundation for the market, especially as many countries diversify their foreign exchange reserves. Silver has an additional advantage because it is both a precious metal and an industrial commodity. Demand from solar energy, electric vehicles, electronics, and AI-related infrastructure continues to support its long-term outlook. If industrial activity remains strong, silver could outperform gold during bullish market conditions. Looking ahead, there are two key scenarios. In the bullish case, softer Fed expectations, lower Treasury yields, a weaker dollar, and persistent geopolitical risks could push both gold and silver higher. In the bearish case, stronger than expected U.S. economic data, rising bond yields, and a stronger dollar could lead to short-term price corrections. Overall, the medium-term trend remains constructive, but next week's price action will largely depend on Federal Reserve signals, U.S. economic data, and movements in the dollar and bond markets. Thanks for watching. If you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments. See you in the next market update.